So in this presentation, we will analyze and recommend the more promising stock that was buying, and analyze stock that have been underwhelming and explain why this stock is not worth getting into. We will recommend buying eBay and selling Woolworths. The global economic has been greatly shaken by the impact of COVID-19 in past 3 years. And many companies have experienced changes in their business conditions. However, there are some companies that have fared better during this shock, just like eBay. So eBay has been affected by COVID-19 and more people are choosing or being forced to stay home for the safety reasons. So which means offline shopping has become unfeasible. So this point promotes online consumptions and eBay upgrade their strategies and systems, which become a factor in attracting more consumers, thus boosting the company's earnings. So online shopping has become a sustainable merchant. According to statistics, eBay continued to grow with 5.1% annual revenue. So eBay will perform even stronger in the economic market in the future.
The reason to buy eBay stock because I think the secondary market underestimates eBay's position in the long-term growth trend related to e-commerce. During the COVID-19 period, eBay user data shows spectacular growth. eBay's new guidelines increased GMV from 23% to 26% during to increase traffic and improve the marketing efficiency. In addition, the platform added 6 million new and reactivated buyers, as well as tens of thousands of small business sellers. The current valuation of eBay is significantly lower than those of its peers, Amazon and Shopify. The current total marketing value of eBay is $248 billion, a half of Shopify and about 3% of Amazon. eBay than Amazon, Shopify, and other competitors in the earning situation, so eBay shares have long-term support power. Secondary market eBay is undervalued.
Hi, my name is Yichen, and I think Woolworths stock should be sold. The main reason is because I think the current domestic and international approach to COVID-19 will affect the company's share price. And Australia has just opened its border. It's still recovering its economic and also China's handling of the post-epidemic situation will become stricter. So in the next few years, not only flight shutdown, but also the requirements on entry and exit goods and strict personal control after the outbreak in some regions. However, most of the raw materials purchased by Woolworths suppliers are from China, which means that Woolworths' existing Australian suppliers have to spend more time to obtain raw materials from China or switch Australia with higher labor and material costs. That will raise labor and freight costs significantly, and the inflation will not easy on. So that's why I put out a sell recommendation.
The reason I recommend selling Woolworths share is that, first of all, the competition between supermarket space is very intense, and with a competitor like Kmart, Aldi, and Coles, in order to keep market share, Woolworths could be forced to discount products, and this action will shrink their profit margin. Secondly, the management of Woolworths' team could be a major worry. The launch of Big W project years ago did not make huge success, but make loss. The Big W earnings crashed 81% and closed two most popular shops this year. So the company need to use profit from hotel and drink business to offset the losses incurred from Big W. Lastly, I believe that the end of lockdown will influence the food retail business. The net income of supermarket space got boosted from panic buying when people were forced to stay at home and they hoarding food and everyday objects. But the situation won't happen anymore when lockdown ends.